All right, simple as usual. I got to go in and change the headset around. Let's see. So as usual, go in and the report, the way the government works is they want the information for the report on Tuesday afternoon. They take that information and on Fridays, they post their report, and that's what we use. So every weekend I go and get the report, just start with Google, and I go get the COT. So I use Trading Stir for this just because they tend to do a little bit better rather than going to the actual COT website. The COT website has a very unimaginative like data sheet, no coloring to it. It's not separated at all. It's just literally a crap ton of numbers, really hard to read. So I do it this way instead. Just go to the home page. Since I got there on a quick link, this is what the home page would look like. And we start with this, just kind of scroll down. Currencies, grains, stock indexes. This is what I generally start with. You have the main S&P, and then you have the S&P mini. The S&P mini, this would be the slash ES that everybody tries to trade, the ES futures. This is the mini, not the micro. That'd be the MES. This is the mini, just slash ES. If you're new to futures or you haven't been trading very long, then you might not realize that there's a full futures contract and then there's a mini futures contract. All right, so just start with the ES full. We don't really look at the dealer intermediary. This that's like the sell side. So, it doesn't really do us a lot of good on a week-to-week basis to go in and look at that. It's not what we want to focus on. We got asset managers and leveraged funds. These are two different firms, two different kinds of firms. Asset managers, institutions, these guys will never attempt to make money to the downside. They only go long and or they hedge against their long and kind of get flat. If you're an options trader, think of being flat like the yield curve or like the VIX curve, something that has a date and time. Well, with these guys, when they're going flat, it would be that they are increasing their short side enough to cover the long side. So every week I come in and I get the calculator out and I look at where they are now and where they were last week. To see last week, we can just take this number for an example, 76,576. If we added that 3.9 back into the number, we would know where they were last week. But I look at this number and I try to evaluate, well, how short are they or how long are they? And what did they do this week? Did they reduce their short position, which would increase their long position? Or did they increase their hedge? Maybe they're looking to protect themselves. Maybe they took profit this week. What did they do? So we also take that information and we think about, well, what happened this week? Was the Fed at Jackson Hole? Did the Fed have a release coming out? Was there a particular thing that they were trading before this report or after this report? Because the information was submitted on Tuesday. We don't know what they did Wednesday, Thursday, and Friday. We're not going to know until next week. And a lot of times they know that as well. They'll wait and hold an entry until, say, the nighttime past Globex Tuesday. And that way they can honestly fill out the report and say, this is what we did. We went long here, we went short here, whatever. And then as soon as the market closes on Tuesday and they submit the report, they can come right back in Tuesday evening and do something else that they don't have to report for another 7 days. So we can see this week that the asset managers increased their long position by 1.2, but that's not necessarily true. They increased their long position by 4,000, by 5,000 something contracts. Now, how did we get to that number? We take 3915 and you add 1273. This is how much they increased their long position, because they took some shorts off and they also bought more longs, right? So that's how much they increased their long position. That's not a significant number necessarily, but it does imply that even though we're sitting at these highs, and even though we have all of this fear and uncertainty, and there's this taper talk and all of these things that the bobbing heads on TV want us to be scared of, the institutions are literally gaining more exposure to the long side, looking for this market to go up. Now that's something to consider, right? That's something to really kind of keep in mind. Leveraged funds. Now, when it comes to institutions or institutional trading, think of the leveraged funds as the retail side, right? They always say that us retail traders, that we're late to the game, that we're uninformed, we're unimaginative, we're uneducated, we're fumbling around just screwing crap up, and they're just out to take advantage of us. And then we always get it wrong, right? If retail's going along, then they'll go short, kind of the implications. Well, we can take that same bias and look at these two groups, asset managers versus leveraged funds. Think of leveraged funds the way the institutions think of us. That if we're comparing these two, this would be the group that gets it wrong more often, that is more emotionally reaction based. They're taking short duration trades, meaning like 6 weeks to 2 months. And they'll trade both sides of the fence. They will make money to the downside. They'll make money to the upside. They don't really care. They'll trade it any which way it can go. And they'll also trade really big reports. They'll trade explosive moves in the market. And they will participate in everything and anything at any time. And they often are late to the game. Or they get it wrong, or they get stuck. So what did they do this week? They decreased their long position, and they decreased their short position. Now they are overall net short. Think about that. Through this entire move that we've had, and it takes time to build a position. Since I've been doing these reports for you guys, well over a month now, week after week after week, they've been short in the S&P every single week. This week is no different. They are net short. And this week, they are still net short. Now, what did they do? They decreased their short position, and they also decreased their long position. Their long position is the hedge that they're using. So when the market goes up, they're going to feel pain. The more longs that they have, the less pain that they would feel. Well, they took some of that hedge off. It's always it's a little difficult to try to grasp, like, what are they trying to do here? This seems a little wishy-washy, right? Like, what did they accomplish here? Either way, we can see that they still have their net short position. They are more net short now than they were last week. We can say that, right? And we can say that because they took some of that long off. So if the market goes down, they'll make money. And if the market goes up, they will hurt more than they would have last week. It's like their bias believes that this market is not looking for a lot of upside opportunity, and that sometime, preferably soon for them, I would bet that it's going to go down. And this is the full S&P. This isn't the mini. We can always validate which ES we're looking at. Just look up here. If it says $50, we know we're on the /ES. And if it says 250, we know we're on the full contract. So now that we've looked at the full contract, let's go look at the mini. So here's the mini. And again, we look at the asset managers. You can see that they've increased their long significantly. 25,000 contracts they increased on their long side. They took 19.5 off the short end and they added 6.3 to the long end. We add these two numbers together. That's how much they increased their long position. Talk about getting bullish in the market, right? These guys just put their foot down on the accelerator pedal. And look at the other group, leveraged funds. They are net short. They took some of that short position off and they took some of that hedge off. So they're trying to reduce their overall position in the market. There are charts that we can look at. So I want to come down and look at the leveraged money. We want to visually see what did they gain here. So this is leveraged money. When it's going sideways, that was the whole of the week. And then when it goes up or down, that is when the week changed. So look at what happened this week. Now we're in the hole because, you know, they're net short. So these are negative numbers. They were net short at 178-ish. And now they're net short at 195-ish. They're more short now than they were. Yeah. Nice and easy way to look at that. They increased their net short position significantly compared to last week, right? But not as big as this week when they took some of that short off, or back here when they took some of that short off. Okay, so that was the ES /ES, the mini. We can go in and look at the Nasdaq now. Asset managers are still net long, but not as much as they were. They increased their hedge and they decreased their long. So they basically increased their hedge by 1,000 contracts. This shows that they're looking at a little bit of slowdown or a little bit of risk in the Nasdaq, and they wanted to make sure that they didn't feel that pain as bad. On the leveraged funds, they did the exact same thing. It looks like on both sides, they bought here and bought here. So they increased their long and they increased their short. Now they're net short in the Nasdaq. So it looks like they just increased their net short position and then they increased their hedge. When we look at the two and we kind of think about, well, what did they do? They just barely increased their hedge. And we can always go down and look at the chart just to kind of get an idea that we're getting the numbers right. We have to zoom in really close, a little closer, that tiny little bit right there between last week and this week, or even more, just right here. Yeah, just that one dot right there, that difference between those two. It's so negligible we can't even see it, right? I rarely come in and analyze the Dow and the Russell. I'm sure that if we did, we would gain value out of it, right? Knowing what the street money is doing obviously helps out in the long run. But this is generally the spot where I start looking at things like the VIX and looking at things like the bonds, maybe even the dollar, and just asking what happened in the dollar this week. You know, did they increase their dollar? Did they short the dollar? What did they do? So for asset managers, they're net long the dollar. They decreased their hedge and they decreased their net position. So they're like taking profit. Leveraged funds are short the dollar and they increased that short slightly on the short side, but they actually decreased their net short position. No, let me say that differently. They increased their net short position because they took some hedge off, right? So they increased their short by, call that 800, by 900 contracts. They increased their short position. So that's pretty significant on the dollar side. Those aren't a lot of big, there's not a lot of full value in there. All right, so to get to this, we always have to hit the button to get there. I normally just pick anywhere in here. Above every grouping, it has this area where it says more in COT. I click on that and I get these choices, right? It kind of opens up more things that you can pick from, and that's how you get here. So from here, I usually go in and look at the bonds. They don't literally have one that says this, this set of bonds. I had to go in and do work and find out it was this one that I want to look at, which we will next. But first, I want to look at the VIX futures. The VIX futures require a lot of buying power reduction. And so when we see numbers moving around in here, we know that they had to put a lot of capital at play to get these futures, and that they would happily use that money somewhere else. The asset managers in here are net long, but just barely 108 versus 96. And they increased that hedge significantly. So it looks like they're trying to get flat in the VIX, but they did increase the one side here. So they increased their long slightly, but they significantly increased their short. Leveraged funds, they are short the VIX. They increased that short while also increasing their hedge against it. So they're not looking to see a lot of risk, either one of these. They're really not looking to see a lot of risk, because these guys would not have decreased their long if they were looking at a lot of risk. And these guys would not have decreased their position either if they were seeing a lot of risk. They would have exposed the trade to an upside move, and they're net short. Now we can go in and see the bonds. And of course, you can hunt and peck through all of these, right? Because the more information you have, the better. But on a typical Sunday, I come in and I hit these numbers. I do my report, kind of do a final analysis, and call it good. So for the bonds this week, asset managers, they're still net long in the bonds. They took money off the table. They cashed out some of their position, and then they decreased some of their hedge. So they're looking for more upside. They're taking some of their hedge off, but they also took some profit. Leveraged funds are very, very short, like almost a 3-to-1 short. They decreased that short position, and they took a little bit of their hedge off. But look at the size of their short position. They're seriously short. Now, these guys are running at about a 2-to-1 long. These guys are running at like a 3-to-1, or 3-to-1 short. That's how different these two firms are. So what do we use this for? Well, when we're in there talking about the market on a week-to-week basis and trying to gauge, what it is that we're looking at, what we think the market can do this week. And, we got a market sitting at all-time highs. How are we supposed to manage, this kind of perspective? We want to look at what the major institutions are doing. If they're feeling risk, they're going to start cutting things back. If they're feeling risk, they're going to start increasing on that hedge side. They're going to buy into the VIX. They're going to hedge against the longs that they're in, or depending on the firm, they're going to take it short. And when there's a lot of ambiguity or shades of gray and kind of wishy-washy behavior, it's not telling us anything, and we just set it aside. These reports don't always have significance, right? We got to look because we don't know, but we're not always going to bring up a report and be like, aha, now we know the answer to the problem. No, not always. So when there's nothing there, we just shrug and say, well, I looked at it. I didn't really see anything stand out. The fact that they were taking a lot of the Nasdaq off says a little bit, and the fact that that they're so weighed in the ES says quite a bit. Now the VIX, I'm doing a lot of looking at the VIX because somebody else had got my attention on what was going on over in the VIX. And when I brought up my indicators and was looking, there is a very large skew right now between the 6-month VIX and the right now VIX. There's almost a $6 differential. It's really wide. They're doing a lot of buying here. And what does it mean when the market is doing a lot of VIX buying very far out? Well, they're getting a lot of insurance, and it basically says they see risk as a possibility, and they don't want to sell their long positions. Think about it. They own, a ton of Apple. They own a ton of Microsoft, a ton of all these different companies, all these different stocks. They don't want to sell it, not unless they have to, and they won't. They will buy insurance so that if the market does burn, they're not going to be the ones burning it. If we go back and look what happened here, when the market crashed in February of last year, there was no safe place to go. Everything went down. Everything crashed, right? There was no safe place. And the institutions got caught without insurance. A lot of them got margin called, and they even had to sell gold just to get enough capital to keep the stock that they owned. And a lot of them couldn't do it. They had to sell that stock and then buy it back later. They don't want to do that again. And to make sure of it, they are hedged to the eyeballs. If this market has an event, none of these people are going to be selling. Well, if they don't sell, the market ain't going to go down, right? I know it's kind of counterintuitive when we say, well, duh, no kidding. If they're not selling, it ain't falling. It won't fall because they're not selling, right? So all the bobbing heads on TV, talking about all the fear and all the reasons why we shouldn't go long and we should all be hedged, and it's going to crash at any moment. Chicken Little, the sky is falling. There are a lot of reasons to be concerned about the market right now. There are taper talk, runaway interest rates, runaway inflation, all these things, the Delta variant, war, and yet the only thing that would cause this market to just crash and burn like it did in February would be an event so significant that it would break even the hedges that they have in place and would cause them to say, that's it, screw it, I'm out, and start selling. Now, I don't know what that event would be, but we never want to say that it can't happen, right? We always have to assume that something could break the market. And every time we think that it can't be broken, well, that's when it does get broken, like in February of last year. So we want to carry hedges, yes, but we don't want to sit out of the trades. We want to take our longs. We want to continue to take opportunities when those opportunities arise, carry the insurance. Just don't go get extra insurance. Don't load the boat. Insurance is money that you burn, right? You literally pull money out of your pocket, set it on fire, and say, I hope I never get that money back. So we got to get insurance because that's what we got to do. But, kind of keep it in perspective. And that's the COT report this week, guys. I hope it helps you out. Enjoy your long weekend, and we'll see y'all Tuesday.